Hi, this is Sandeep, Anand. How many times it has happened to us that we track certain stocks, we don't own them, but we track certain stocks to enter or to buy, waiting for a right time to enter because it has gone up in price a lot in the past. We'll be thinking like, oh gosh, it has already gone up 5, 10 times. It's too late to enter now. I missed the boat. I would rather enter at a point when it corrects in future and wait, and we probably not enter at all. That's not the right way of investing, looking at the valuation at a point in time without considering a multitude of other factors that includes total addressable market, etc. Let me walk you through four such scenarios, four such stocks that pertains to different industries, different businesses across different geographies that has done the same stuff so that we can correct this biases. There are two biases pertaining to this. It's anchor bias due to the price anchor that has fallen in our place due to tracking. And second is the recency bias, because in recent past, it has gone up so many times, we tend to hesitate to enter in and buy that stock. How to overcome that? Let's get into this. So the first stock out there is pretty much happening stock right now, is a company that's happening under Toby Lutke. It's Shopify Incorporation. So Shopify, look at this chart, and you would see in the last 5-year period, starting 2016, all those arrows indicate the points at which we could have entered into the stock. Shopify is up around 40 times in the last 10 years, and it has given most of the returns in the last 5 years. We could have thought that all those points, which are blue arrows, that we missed the bus. It had doubled from 2016 to 2017, tripled from that point, gone up 3 times from that point till 2018-19. From that point, it went up another 5 times. So the journey has been continuously improving and increasing in price, reaching up to 40 times in the last 10 years. And the best part is, even today, as I'm taking this video, Shopify announced their results, giving a bumper earnings report. Their revenues ran up 110, 120% around, and improving their gross margins, operating margins, and growing the GMV, gross merchandise value, like anything. So and the Shopify stock is up 10% just today. Many people have exited the stock many years back, citing the valuation reasons. They exit in 2018, 19, 20, continuous. And even I have trimmed a lot of position Shopify, although I still hold. But the idea is, for many people, never entered Shopify stock for the sheer reason that it has gone up a lot in the past. Next stock is an Indian stock, which is Indian bank, retail bank, which is the largest private bank in India, called HDFC Bank. The interesting part is it's also listed in NASDAQ. It's also listed in US and New York Stock Exchange. And you could see the ADR price I put in. I'm not putting the Indian rupee price chart here. It's a similar chart out there. So you could see HDFC Bank in the last, say, 15 years, 20 years in the chart. There are so many blue arrow points we could have entered, but every time people couldn't enter HDFC Bank for the sheer reason that it has gone up a lot. At every point of time, it looked pricey. Valuations looked stretched, which happens for most of the quality companies, quality banks, and quality businesses out there. That point of time, this is one of the hurdle factor which is stopping people to buy. It's not only that it's gone up so many times, it is also because the price looks high at that point of time. All these blue arrows you can take could have entered anywhere and could have multiplied our money so many times. Just in last 10 years, it's a behemoth bank, but even then in the last 10 years, it has multiplied 8 times approximately. The next stock is a South American giant, e-commerce giant, rather more focused on Brazil. It's MercadoLibre. More than an e-commerce, I would say they are payments play. So MercadoLibre is a stock. Again, I put a chart in the last 5 years. It has gone up totally 12 times in last 5 years. At all blue arrows, we would have thought you missed the bus, but the returns have continued to compound. The business is continuing to fare well, and it's still growing at 90, 100%. We could have entered at any points of time in the blue arrows. Again, MercadoLibre looked pricey, and even today it looks pricey. But if we had entered at any point of time in the blue arrows, we can still make money. We could have made money multiplying multiple times. Now, this chart out there, covers multiple biases. It's not only the hindsight bias. It's not only the anchor bias, it is also the size. I mean, this one is my own regret and mistake every time I say this, because missing the bus on Apple, I missed the bus 3 to 4 times. Look at the chart out here. It's a very well known company since last 10 years. In just last 5 years, Apple has returned 4 times. And in 2015-16, it was a very well known company. I mean, the sales are rocking there. I mean, revenue is great. iPhones are doing great. For I don't know whatever reason, we tend to miss this one, and it has gone up 4 times in 5 years. And Apple had multiple entry points in the last 8-10 years. But this is another thought process. It's a size. It's so large. How can it go up further from this point? That's one line of thought that has been corrected for me. And the anchor bias has gone up so many times, whether to enter now or not. So to summarize, it's usually never too late to buy into a winning business and a winning company and its stock. It's a bad idea to sell your winners early, especially missing out on huge long-term gains, multiplying gains in the future, selling out after it just doubled or tripled. The biggest hurdle for this kind of a behavior, not buying the stock because it has gone up recently higher, is called the recency bias, and it's also a certain amount of hindsight bias. It's also anchor bias, because we look at whenever we start tracking that stock and it has gone up just 50% from that point, we tend to stay away from buying that. That's the anchor price that is playing in there. So we have to come over these two biases. So these examples, I hope, will help us all to rectify those biases or come over those biases. It's very difficult to buy a stock that has gone up 2 to 3 times. It's not easy, especially in the near past. Now, how to overcome? Rational approach. Stocks and company performance are moving up for a reason, and they are growing due to underlying fundamental reasons. So we need to really take a rational approach, not just look at the numbers out there. Look at the way they are growing. Their total addressable market is growing, how the earnings is growing, how their market share is growing, what the company is innovating in different aspects. It's a holistic approach. I mean, it's not just the numbers that we should consider. Second point is every 50 or 100 bagger, which means every stock that has gone up 50 or 100 times once had doubled or tripled initially on their way up. That's the key message that I wanted to leave with you. And thanks for staying with me. See you again. This is Sandeep Anand signing off.